Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 72. And on the podcast this week, I wanted to cover a health insurance strategy that I mentioned in passing an episode or two ago that has to do with the most recent round of stimulus signed into law by President Biden. There is an opportunity to obtain health insurance through the state exchanges for 2021 and 2022 at potentially a substantially lower rate. And as you probably know, these state exchanges were created a few years ago, back when President Obama was in office, as a result of his legislation, the Affordable Care Act. And if your income is low enough, the federal government subsidizes some of the premiums, and you pay less out of pocket to obtain a policy. Well, that cap was 400% of the federal poverty line. But in the most recent stimulus package passed by President Biden, even if you make, there was a change made to this for years 2021 and 2022, to where even if you make above that threshold, 400% of the federal poverty line, you can still take advantage of healthcare premium subsidies if you obtain your coverage through the exchange. So since health insurance is such a hugely expensive thing, particularly for those of us who have to get healthcare on our own as opposed to through a larger group or employer's plan, this could be a really, really nice opportunity. And I wanted to cover it on the podcast because there is a special enrollment window that's currently open and is set to close on May 15th. So it's an opportunity for this year and next year. You can always wait around until open enrollment at the end of the year to make adjustments for 2022 only. But by virtue of the law being passed here at the beginning of 2021, part of the bill created a special enrollment window that allows us to make changes here in the middle of the year, which is ordinarily not an opportunity. So that's what we cover on the podcast this week. I hope you enjoy it. This is healthcare is kind of a touchy subject for a lot of people because it's really exceptionally expensive if you have to find it on your own. And I think it was, at least for me personally, it was kind of a rude awakening when we had to go down that road after I resigned from a really nice job with really great benefits. And we figured out that getting health coverage on our own was just an absolute nightmare for my wife and I, and then for our kids. And the hassle and the cost. We pay a couple thousand. We pay about $2,000 a month for a reasonable, not tremendous, but definitely not bare bones plan for my wife and I and our 3 young kids. And as part of the Affordable Care Act, a couple of years ago, well, more than a couple of years ago now, probably 2012, 2014, I want to say, when that was passed. Part of the logic behind that piece of legislation is that Obama wanted to create these healthcare exchanges on a state-to-state basis. And so if you're alongside that, he wanted to force people to obtain health coverage. And because the idea here is that if we have a lot of healthy people in this country, we have a lot of unhealthy people in this country, you don't tend to pay for insurance if you're on the healthier side of the equation and you think you don't need it. So therefore, if you force everybody to get it, it becomes a little bit less expensive for the less healthy people that are making claims on their policies over and over and over again. So by expanding the pool, this is my understanding of part of the logic, which I'll admit is pretty limited. But it basically goes, you widen the pool of people who are paying premiums and potentially making claims on these policies. And by offering these state exchanges, making it easier for people to sign up in the first place, that's going to lead us down the road of a much better and less expensive system per capita. And this is such a political thing that a lot of people feel like being required to obtain health insurance was an infringement on their rights. And I think Trump actually got away or did away with that requirement once he came into office. But regardless of all that, part of the deal with the Affordable Care Act was that if you access a health plan through a state exchange, the federal government might come in and subsidize some of your premium. And so by doing that, you're helping lower income people afford health coverage. And so the way it works is when you sign up for health coverage through an exchange, you tell the exchange what your income is. And I don't know whether or not you're required to submit like your tax return or documents or anything like that, or whether you can just tell them what your income is. But they calculate the premium that you pay out of pocket based on that number. And so if you're someone who makes $500,000 a year, you're not going to qualify for any of these premium subsidies because you make too much money. And so if you sign up for health coverage through the exchange and you punch in $500,000 of annual income, well, the monthly premiums that you'll see offered from the selection of plans that you have to choose from is just the rack rate based on you and your family's ages and tobacco use and other health factors. But if you're a lower income person, then the healthcare exchange takes that rack rate and then reduces it by a certain percentage based on where you fall in this spectrum. And so the way it's worked historically is that it's all based on the federal poverty line. And if your income as a household is less than 400% of the federal poverty line for people in your area with the appropriate number of people in the household, then your premium will be reduced. And then what you do is it kind of comes out in the so you might think, well, why don't you just enter, even if you're making $500,000, why don't you just enter a really low number like 30 grand or something like that and qualify for these premium subsidies. And the idea is it comes out in the wash when you file your taxes at the end of the year. And there's an area where you include information. There's a form where you're supposed to include information for when you did and did not have coverage. And there's another form that you're required to include in your return that trues up your actual income versus the amount of premium subsidy that you received. And so one of the weird byproducts about the stimulus last year was that there were a lot of additions to the federal unemployment insurance program. So for people who are, were working and were on the lower end of the income spectrum and then got laid off and started qualifying for unemployment insurance, there were a lot of people who were getting these healthcare premium subsidies by obtaining their insurance through the exchange. But then when they got laid off, they were actually making more money through the various unemployment support at the state and federal level, which means that when they filed their taxes for the year, they didn't end up actually qualifying for the premium subsidy that they thought they would, and they had to cut this big tax this big check come tax time to true up and make up the difference for those premium subsidies, which is an unfortunate byproduct of this whole thing, and I'm sure was not an intended consequence when the legislation was passed. But at any rate, that's basically how it works. And so if you make more than 400% of the poverty level, you can still qualify for health coverage by going through the exchange. And that was another part, a positive part of the Affordable Care Act, in my opinion, is they can't turn you down based on pre-existing conditions. Everybody can get health care through the exchange, regardless of the situation you're in. But the amount that you're going to pay is dependent on your income. And the other ordinary factors. So previously, if you were making above 400% of the poverty line, you're just going to pay the rack rate. Whatever that cost of a health insurance policy is on its own is what you're going to pay. Well, before I get there, let's put some numbers to this. And I've got this in front of me for those of you who are not watching our videos and are just listening. And by the way, we just started posting these to YouTube, so check them out if you're interested. I search for Three Oaks Wealth, and you should see the podcast videos on there. But anyway, the federal poverty line is split into 3 geographical regions. The biggest region is the lower 48. Well, I guess people down here call it the contiguous 48 states. I grew up in Anchorage, Alaska, and Alaskans call the contiguous 48 states the lower 48, just based on the geography. But anyway, for the 48 contiguous states and Washington, D.C., a family of 2 has a poverty line of $17,420 in 2021. A family of 4 has a poverty line of $26,500, and it continues going up above that. Well, Alaska and Hawaii have their own poverty lines because the cost of living is substantially greater in those states. So whereas your poverty line for a family of 2 in the contiguous 48 states is $17,420, if you're in Alaska, it's $21,770, and if you're in Hawaii, it's $20,040. So the more people that are in your household, the higher the poverty line. And the idea is the amount you pay is a function of where you live and the number of people in your household against your income, of course. So that's how it was previously. Now with the most recent stimulus package, one of the cool things, cool in the sense that it could be a nice planning opportunity for a lot of people out there, is that there was a cap on the amount that you're going to pay for healthcare through the exchange. And so whereas previously, if your total income, and this is defined as, I believe, adjusted gross income, so all your income sources before any deductions, if that's greater than 400% of the poverty line, the maximum you're going to pay is 8.5% of your income. And there are these different tiers, and I didn't look this up, to be honest, but I think if you're between 300 and 400% of the poverty line, then you pay 8.5% of your income. If you're between 200 and 300% of the poverty line, then you pay a little bit less than 8.5% of your income. And it keeps going down the closer you get to the poverty line. But previously, if you're above 400%, you don't get any of these premium subsidies. Now, if you're over 400%, you do. And the amount of the premium subsidy is based on the difference between the rack rate of the policy through the exchange and 8.5% of your annual income. So this is a really, really nice opportunity for a lot of people who wouldn't otherwise qualify for these premium subsidies. And so I did the math on this, just kind of curious, because we pay so much, as I mentioned, for healthcare as a family. And like I say, we pay about $2,000 a month for a family of 5 and kind of a middle of the road plan. And what that means for us is that if we made $150,000 a year, 150,000. Let me do the math on that. Actually, 8.5% of 150,000 is $12,750, which means that rather than pay $2,000 a month, we could qualify for this thing and pay $1,062.50. And you think of a family making $150,000 a year as doing quite well, and that's I'm not going to disclose what we're how much we're making as a family, but the fact that if you're making 150 grand, you can still cut your healthcare costs in half is a really nice opportunity. Now, not everybody is going to qualify for this because if you're making like $1 million a year, or using our example again, $500,000 a year, the rack rate of that healthcare policy is going to be less than 8.5% of your income. So there's a threshold here where you just want to pay the rack rate. You don't want to get involved in this 8.5% business. Or realistically, if you obtained healthcare coverage through the exchange, you just simply wouldn't qualify for any premium subsidies. So in running those quick numbers, that threshold for a policy that costs $2,000 a month, if I just take $2,000, I multiply it by 12 to get an annual amount, and then I divide it by 8.5%, I get $282,000. So for a family like me that pays just out the ears in health insurance for a really pretty healthy family of 5 with some young kids, if you make anywhere less than $282,000 a year, you can take advantage of this and reduce the amount you're paying out of pocket. And again, I'm not going to disclose where we're at and whether we're going to do this, but think about that. I mean, this is a portion of the stimulus package. Everybody was focusing on the stimulus checks going out and getting in people's pockets and bank accounts as fast as possible, the Paycheck Protection Program, and a few other areas. And this was a lesser known portion of the law that I think got swept under the rug in a lot of news outlets and just in the general public. So it's going to be an opportunity for a lot of people. Now, you might be thinking, well, the bill got passed at the beginning of the year. We can't enroll in anything until open enrollment at the end of the year, which would be effective January 1 of 2022. This deal and the way it was written in the bill, this limitation of 8.5% of your income is only valid for 2021 and 2022. Beyond 2022, it goes away. So what they did was add a quote unquote special enrollment period, which means that where you otherwise wouldn't be able to make changes to your health plan in the middle of the year, this is a special window that's been opened, and it's open until May 15th. Now, the way this works is, so if you think it's an opportunity, you want to kick the tires on it, I would probably go to your state's healthcare exchange and just start poking around and punching in numbers and just see what happens. Because I have spoken with more than one person who was really interested in this because they felt like they were paying out the years for insurance. They thought it was a nice opportunity, so they called the reps at their local state exchange, and the people that they spoke to 2 or 3 different people. Nobody had heard of what we're talking about today on the podcast. Now, that was pretty shortly after the bill was passed. And, these state exchanges are all individual organizations. The people that you get on the phone, not to, denigrate anybody, they're notoriously good at giving really bad answers and things that are directly just factually inaccurate. And it's been the source of frustration for myself. We used to get our healthcare through the exchange years and years ago, and for a lot of people that I've spoken with. So the bill was passed. That means that state exchanges across the country are going to have to comply with this new stuff. There's probably some window of guidance that was written into the bill. I don't know what that was, to be honest, but it may be the case that if you call someone on your state exchange, or if you start poking around on the website, you're not going to see anything about your this special enrollment period or your ability to collect these premium subsidies based on your income, because they just haven't rolled it out yet. They haven't synthesized the bill. They haven't executed anything that they're going to be legally required to do. So don't fret. This will be an option. I don't know what exactly the timing on it is as far as when states will roll out the updated requirements from our federal legislators. Man, I'm slurring my speech here. It's Friday afternoon. But it will be around soon. And you have until May 15th, like I said. After that, the special enrollment period will close, and you'll have to wait around until the end of the year during open enrollment to make any other changes to your healthcare plans that would then become effective 2022. And then again, this special stuff, this 8.5% cap, goes away at the end of 2022 in favor of the previous system, which again gives you these nice premium subsidies, but your income does have to be underneath 400% of the federal poverty line. So that's about it. It's a really nice opportunity. You know, we've got clients at the financial planning firm who use health share plans. Some have had pretty good success with them. I haven't heard any terrible horror stories about them. I have concerns about using a health share plan because it's not a legally binding insurance policy. They can kind of turn you down if they want to. But I mean, for a lot of people who are in that situation, this might be a really nice alternative for the next couple of years. The other thing that I'll add is health insurance is kind of, I don't know, opaque. I want to say it's not very transparent. And I've always had a sense that if you have a policy that's working for you and you're not paying a whole lot in premiums and you're not getting just totally creamed with premium increases year after year, if you left that policy in favor of a policy or if you abandoned the policy in favor of one of these health exchange policies that we're talking about today to capture these premium subsidies, you might not be able to return to the old policy that you had. And so be cognizant of the fact that if you leave what you have, you might not be able to get back into it later in 2023 and beyond in its current form. That's not to say that the structure of your plan doesn't change substantially over the next couple of years anyway. I really don't know how health insurance companies are legally, like what they're legally able to do and not do with regard to changing their programs year to year. But this is kind of an evolving landscape that is certainly ripe to change over the next decade or so. So there you have it. I'd love to have a guest on the podcast who really knows a lot about like macro healthcare issues and spending per capita. And I mean, you look at the amount that the U.S. spends on healthcare as a country per capita compared to other countries around the world. And I don't have the stats in front of me. I wish I would have brought them up, but it's staggering and tells us that we're doing something wrong. And I'm not smart enough to know what that is. I don't know that industry well enough, but I mean, we're spending 2, 3, 4 times the amount that a lot of other countries are because of the structure of our marketplace and insurance system here. So that's a rant for another day. Or maybe I should have a section on here that's called Rants from Grant. Grant's Rants, maybe. It's been a long week, people. Sorry for going off the deep end here at the end of today's episode. But that pretty much does it. This is a really nice opportunity. Again, think of the example. You know, if you have a family of 5, you're paying, you know, a couple $1,000s a month, or maybe even $1,000 a month for healthcare. You could substantially cut into that cost over the next couple of years by taking advantage of something like this. Downside is you've got to change coverage. Maybe you have to change doctors as a result of that, which is a huge pain in the neck. Dealing with the state healthcare exchanges across the board, I have to warn you, be prepared for a nightmare. It's kind of like being on the phone with the IRS. It takes forever. You often get bad answers. Just be prepared for an uphill battle there. But if the savings are worth it, maybe that's a fight worth fighting. Okay, that's it for today. Hope everyone is well and healthy, and I will talk to you all soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.